for a look at how the Fed is factoring into investor thinking right now. We're joined by Andrew Slimmon, Managing Director, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, always great to talk with you. So let's just start with how you are thinking about the Fed at this point in time. Saw some surveys this week that folks are looking for a policy change, maybe around Jackson Hole, so call that 8 weeks or so from now. What's your thinking on the role that Fed policy is playing in today's market setup with stocks basically at a record and 10-year yield continuing to come in?
Yeah, good morning. It's a great question. So look, I think it's important to take a step back. And if anything we learned last year, it was don't fight the Fed, right? We had a terrible pandemic, ravaged the world, and yet equities went up. Why? Because we had very accommodative central bank policy. And that's not changing. Tapering is not tightening. So whether they taper or not, or they begin to think about tapering, it's still accommodative. And I would remind you in 2013 that when the Fed mentioned tapering, the market did pull back 5%, but then it went on to a 16% rally before they actually began to taper. So I think that's the most important thing is we still have very accommodative Fed policy. And in that environment, you want to remain constructive on equities, regardless of what is the outcome today. I think the very fact that you're seeing some commodity prices come in near term, to me, that actually supports their willingness to remain on the sidelines, to remain accommodated. So I don't expect anything out of the Fed today. And I do think that this will reinforce their belief that unemployment, income inequality is a higher priority than inflation. And the fact that inflation's come in helps them to further stay with that. I think that's the most important two messages. And that has longer term out there, but not.
There you have the opening bell on Wall Street on this Fed Wednesday. Convey Health Solutions, ticker symbol CNVY, ringing that opening bell. I'm sure a very exciting day for that team over there. Andrew, so if the Fed is likely to still remain a friend to markets in the near term, what triggers that potential 10% to 15% pullback that you see in the cards this summer?
Well, yeah, I mean, the thing that worries me about the 10 to 15% pullback is it seems like everyone's expecting that. And, we have had so little volatility since last summer that eventually we are set up. And what does worry me is the VIX is now down to a very low level that usually leads to a setup of some type of correction. So I don't know what it is. I just know that the market is more vulnerable now with low expectations of volatility. You want to get more cautious than with high expectations of volatility, which is what we've seen up until recently. So I don't know what it is. Maybe it's a macro event, and maybe it will be the Fed tapering. Could we have a correction on that? I just don't think it's going to be that substantial. With look, take a step back, think about this very clearly. Earnings are going up. We've had very good revisions, and we have Fed policy that's very accommodative. Those are two very powerful things. And yes, we're seeing some inflationary pressures, but I don't think it's substantial enough to really worry. And as we're seeing things like lumber and copper and some of these commodity inputs pull back, I think that further supports it. Maybe we just won't have a 10 to 15% correction. But what's important is, as opposed to trying to predict what will cause the correction, just be aware of the fact that the market is more vulnerable now because of VIX, volatility levels are very low, which means expectations of a pullback are low.
So, but at the same time, in your note, you also say stocks are going to go up after that. So everything's going to be fine. I mean, it's sort of channeling what is a frequent theme of our morning brief notes by Myles, that stocks tend to go up over time. Even if things pull back, they're probably then going to move higher.
Tapering is not tightening. Tapering is not tightening. So even if they say they're going to begin to taper, it's not tightening. And you want to remain on the side of equities until the Fed tightens. I think that's what's very, very important. And, I go back to, boy, oh boy, there was a lot of reasons to be bearish last year, but the market did very well. And let's not forget why. It was central bank policy was very accommodative. And I think there is a major philosophical change going on at the Fed. The Fed is leaning more towards encouraging better employment, encouraging better labor wage gains at the expense of inflation. So I think they're going to sit on policy longer than people expect. And that could have implications for inflation down the road. That has implications for the types of stocks you want to own. And I, as a portfolio manager, I reflect that. But I think it's bullish for equities for a longer period of time.
And, Andrew, we have about a minute left. I just want to ask, quickly before you go, a conversation we've had, recently with guests in the last few weeks is the state of the rotation that has defined markets into more value type names, cyclical type names, away from growth. Certainly signs of life in the NASDAQ as of late. What are you seeing in terms of how far that rotation has gone and may go?
Well, look, I do agree that some of these commodity prices is transitory. So you're starting to see lumber prices come down. You're seeing copper come down. I would be a little careful on oil because it's just had a big run, and I think that'll follow suit. So I think the argument of transitory is a valid one, and that's why you're seeing a rotation into growth stocks, because I think, managers are saying, or investors saying, see, inflation is not a worry, so we can own the growth stock. And so they were very oversold relative to value. Value has done very well since last fall relative to growth. And so it doesn't surprise me we're getting a little bit of a rotation back. That's probably healthy for the market. But at the end of the day, don't lose sight of what the Fed is saying. The Fed's saying, we're not as worried about asset bubbles. We're not as worried about inflation. We're worried about income inequality. And that has inflationary implications down the road. So I think you'll get a little bit of a short-term growth bounce relative to inflationary cyclical stocks. But when I think about our portfolio and how we're weighted, I want to have a little bit more of those inflationary sensitive stocks more than normal, because that's what the Fed is saying is their priority.
Yeah, everyone very quick to go back to those secular type names that worked over the last decade. But I think, as you kind of outlined there, different set of circumstances these days and a different mindset from the Fed. All right, Andrew Slimmon with Morgan Stanley Investment Management. Andrew, always great to get your thoughts. Really appreciate the time this morning. I know we'll talk soon.
Take care, guys.